Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth.
Well, I'm continuously asked in the media, tell me what the next 10 hotspots are going to be. When do you think interest rates are going to rise? When do you think interest rates are going to fall? When's the next property boom going to end or start? When's the crash going to come? Because I guess they're the headlines the media wants, Jared. But I tend to disappoint the journalists by telling them I actually don't do forecasts. Instead, I have expectations. So I expect that we're going to have another recession in the next decade, Jared, but I don't know when that's going to be. I expect some of my investments won't do as well as I'd like them to do, but I don't know which ones they are. I expect the property market to rise for the next couple of years, and then it's going to peak and it's going to fall again. But I don't know when the current upturn phase of the property cycle will end. I expect interest rates are going to remain high for a while longer and then start falling. Probably not until maybe the last quarter of this year, but to be honest, I don't really know when. And I guess I've learned that every decade or so, the world breaks, so we're going to have another financial crisis of some sort, but I've got no idea when. Now, Jared, these aren't contradictions. It's not really a form of cop-out. You see, there's a big difference between an expectation and a forecast. So the expectation is the acknowledgement of how things worked in the past and are likely to happen in the future. On the other hand, a forecast is putting a time frame to it. So, of course, in an ideal world, we'd love to be able to forecast what's ahead for our property market, and we want it with a level of accuracy, but we can't. There's just too many moving parts, and boy, all the wrong forecasts over the last couple of years have shown this to be the case. Sure, there's all those statistics that are easy to quantify, but what's really hard to identify is exactly when and how millions of strangers are going to react and respond to the prevailing economic conditions, political environment, and what millions of other Australians are going to do. There's always X factors. So it's actually made me invest differently for myself and for our clients personally, because if you've got an expectation without a specific date, a specific forecast, I expected the last property boom to end. Now, I didn't expect COVID. That's one of those X factors. But when things happen, I was prepared for it. I had financial buffers. I owned the right sort of assets in the right entities, and it didn't shock or scare me when things like that crept up, Jared. So while early 2023, in fact, late 2022, being on the ground, we saw a lot of signs that the property downturn of 22 was ending and the property market was going to pick up. Even with all that, I didn't predict or think the market was going to be as strong in 23 last year as it was. And in fact, at the beginning of this year, we had some thoughts about where the market was going to end up in 2024. But boy, has it already shown us that a lot of forecasts are wrong. Some segments of the market, some states are outperforming expectations and others are underperforming. Perth's one of the markets that is well outperforming at the moment.
Well, perceptions are going to have to change, and I'm not sure what you see in the other capital cities, but Perth, for a long time, people haven't embraced that higher density living. But now that we've got migrants, we've had one of the highest population growth percentages over the last year, the highest of all the capital cities. We've got a lot of people coming in with different expectations that are embracing that higher density more. Even though most Perth suburbs have experienced 30 to 50% growth over the last 3 years, some commentators are saying that we're getting overpriced, and others are saying that we might be reaching the top of our growth period. I think the majority aren't saying that. I'm certainly not saying that. They're just looking at the 30 to 50% growth over the last 3 years and saying, gee, that's a lot. How much more can Perth really grow? But what I'm very much focused on is our average annual growth rate, which was 1.6% over the last 10 years. It's still got lots of growth to make up for and be in line with that 30-year average, which I just said was 5.65%. So that's why I believe there could be at least another 40 to 60% growth to get back to this long-term average and be more in line with the other capital cities. If we experience that 40 to 60% growth on our current median house price of $625, that would set us up to be at around $900 to $1 million median house price. Sounds high, doesn't it? And it's a little bit hard for us to contemplate, could we actually be worth $1 million for the average house, the typical house in Perth, within 2 or 3 years? And it does seem hard to imagine. But when we look around the country, Brisbane's median house price is at $817 compared to our $625. Sydney's median house price is already at $1.1 million compared to our $625. And Melbourne at $778,000. And so Perth seems to me to be really undervalued along with Melbourne. It makes it seem a lot more possible that we could be worth $900 to $1 million, especially when I consider that Brisbane, Sydney and Melbourne are all entering their growth phases again. And the more that they grow and make us look undervalued, yes, we're growing at a faster rate. I think we're going to catch up. And I think we're going to end up at somewhere between $900 and $1 million before we get to the end of this growth phase. The growth rates have been less from what I've seen anecdotally on the specific properties for units at typically 2 to 5% versus houses at 4 to 7%. Why should you consider a unit if your budget is $550,000 or below? And I've come up with 4 reasons to cut through and for you to see whether this might be an option for you. Now, from the above stats, it's clear to me that units are way undervalued and there should be a significant correction and closing of the gap, taking growth back to being in line with the long-term averages, because we've had negligible and negative growth in units at the median house price level. And when I look down at the specific units at the moment, certain segments of the market are coming back earlier than the others, but still there's a huge amount of catch-up that's needed to bring us back in line. And if houses are going to go to $900 to $1 million, even if the gap stays the same as it is now at $200,000, then we could likely see units being at $700,000 to $800,000. And when we compare that with the prices today at $425,000, a lot of growth upside there that should happen at some point. I don't know exactly when, but I'm seeing it already starting to occur. So there's a lot of upside in the shorter term is my point there. So even if it might not suit you for a long-term hold, you could certainly benefit and gain a lot of wealth in the shorter term. My second point for why you should consider purchasing at $550 or below, and it leads in nicely from the first point, is that you can still build wealth with a 4 to 5% average growth rate over the long term. And even at 4% growth, buying a $500,000 villa or something today would potentially be worth $740,000 in 10 years' time. And that's based on a 4% growth rate, which is very conservative and certainly possible. So going from $500,000 today to $740,000 in 10 years' time. And I think that things will probably exceed that. Certainly if the median house price gets to that $900 to $1 million, I think this median for units could be a much, much higher. And I'm looking at the change in a $500,000 unit here. So in 20 years, when we extrapolate that further forward, a 4% growth rate would change a $500,000 unit to a $1.1 million unit in 20 years. So just over double in 20 years. So if you only put $50,000 to $100,000 deposit in, that's still going to be a great return in 10 years. It would be a 16.9% average cash on cash return per year if you invested $50,000 or a 10% deposit into the property, which a lot of people that are buying at the lower end typically do have that 10% deposit only. But if you invested a 20% deposit, you're looking at a 9.1% return on that $100,000 invested. That's the cash on cash annual return average over 10 years. Why I would look at buying a unit if I had a budget of 550 or below, is that with a lot of the growth likely to come over the next 2 to 3 years, is going to give you an equity gain that you could use to leapfrog into better assets. And so just because you start out buying units or dump houses like I did and renovating them doesn't mean that you keep buying them forever. And I've seen this evolution with myself personally and with our clients, and everyone has to start out somewhere. So don't necessarily look at it as a forever type of property that you're going to keep buying. I'm not suggesting that you sell your units either, because as a part of an overall portfolio, they can make up, more of an income component. And every time you buy and sell properties, you have changeover costs. So you'd only sell it. I'm more a fan of selling those higher density, more modern apartments that are only going to get 2 to 3% growth. And so those assets I would suggest selling strategically. But if you've got an older unit complex, I would look at it case by case as to how the historical growth's been on those. Really with any villas or duplex halves, I'd look at how it's historically been on those too, but I'd be much more inclined to keep those as part of an overall portfolio longer term. So you can use it as a leapfrog to get into better assets, and you don't need to be buying units forever. We're always looking to buy into areas that represent more value at an individual price point budget for someone. So even if your budget's towards the lower end, once an area becomes overpriced and represents greater value than other lower end areas at any suburb, we would then look to target those that represent better value, and still making sure that they've had a longer term history of better growth back looking as well. So hopefully that gives you some insight as to what's ahead. Will peak values hold? Well, I think that's really going to more come down to how soft our economy landing might be, and whether we sort of can sustain and continue. Probably going to depend what happens globally with the need for our resources, and what also happens with interest rates. So what I'm thinking as well is, when we look ahead, interest rates are going to hit their peak at some point, probably at the end of this year, next year. You can imagine what that's going to do when people realise that we're at the top and potentially even start coming back. That's really going to kick the market into a whole nother gear. And I think that's going to really surge things in Perth, not let alone around the country. So that'll be another sort of key point, a phase point. And I'd really be trying to get in before that happens, because I think it's going to go next level. And if we think it's hot now, it's going to be boiling by then. So will values hold? Well, it's going to depend probably how far we overdo things, and how soft our landing is with the economy and sort of overall availability of jobs, and what that does for population growth. So as the population growth continues, if the jobs continue, then that's going to really soften our landing, and hopefully resources and other industries can be held up to support those jobs and keep things with a really solid foundation and fundamentals. Tips for the first time investor, please. That's a pretty open and broad question, but I'll give an answer for where to start, because I think back to when I read my first book, Rich Dad Poor Dad, at age 16, getting a smile on my face just thinking about it. So I do reread the book every couple of years, and I get new meanings, and it's awesome to sort of look back at how that inspiration has motivated my path and how far I've come as well. So it's really cool to reconnect with the book. But get educated, read that book, read lots of books. The more that you can add into the mix, you can sort of condense that down to your overall investing philosophy and understanding. You can see who resonates with you. I'd listen to podcasts. Hopefully you're listening to this one right now. I'd build a team of professionals, and the key for that is looking at people that have got personal investing success and experience, and birds of a feather flock together. So, I'm going to have a really great accountant, finance broker, settlement agent, building and pest inspectors, because I've gone about finding the very best to work with me and my team on the property management, strategy, buyer's agency, and selling sides of things. So if you find the right team you can then go about creating an overall plan. And this can be, I'd prefer to have, if I was starting again, I'd love to just have this plan from the beginning. It's not like you set your plan, never forget about it. Never change it and just forget about it. You review it each year. Things change. Your goals will change. And what you think is possible for your own future will change. So that's going to open up a whole world of possibilities where you need to revisit your plan and decide, are these properties going to get you there? Do I need more? Do I need to reshape what's in my portfolio for your new goals each year? So get in touch if you think a strategic plan will work, and we can certainly help with the execution and the team. And I'm sorry, but you're the only one that can get educated for yourself. I'm here to help on that front too, so tune into more of the podcast. Good luck. How are bank valuations on property purchases faring against what this person's calling inflated prices some properties are fetching at the moment, and how is this affecting loan approvals? So, good question. I've been pushing asking prices on all the properties that I'm selling, and with so few on the market and so many buyers who have often just missed out on another property, they come in all guns blazing, and in just about every case, properties are selling for more than their asking price. And even last weekend, for instance, I had properties asking between 450 and 750, and I sold one of them for 90,000 above asking, one of them for 102,000 above asking, and the other one for 100,000 above asking. So nearly 100,000 average above the asking price, which is crazy. So that's also obviously to do with how I go about creating competition, getting people to pay a more emotional price and get that fear of missing out. And it makes a big difference in the prices that I'm getting. So take the case where, an average agent who doesn't have an overall strategy for getting the best price, and I've run through in a different podcast episode previously what my strategy is with its 5 sort of points. But you can imagine that a seller may still be happy, getting 20 or 30,000 over, but they don't know how much money has been left on the table if they just had a really great sales agent to strategically approach their sale and really drive the price up to a more emotional one. So there's certainly times when I've been worried that the price that I've got, are the valuers going to value it at contract price? Are we going to have a problem here? So in my experience over the hot market over the last few years, valuers have been very understanding of how things are out there, and they're keeping pace with things, and they are more looking to what is under contract, not what sold 2 to 3 months ago and settled, because anything that's not current and not now is dated, and the market can gap up very quickly on where the prices are. So there's been a few times when I've had to talk a valuer through the level of interest that I've had, what other offers I've received. I'm really trying to substantiate the valuation to come in at contract price and make them feel better about valuing it there. So I haven't had any fallover on finance despite selling them for significant amounts above asking. I have had to certainly substantiate things to quite a few valuers, and a good sales agent will know how to do that and how to really fight for the valuation to come in at contract price so you don't get any hiccups. Now, let's say that the valuation doesn't come in at contract price. I think buyers need to also understand that that's a possibility and have some other equity or deposit to use to bridge the gap on things, knowing that they could look at refinancing in 6 months' time. Things are going to be much higher still, so they could then pull out the extra money that they've had to put in to bridge the gap. And I still wouldn't let that deter me, but if I was a buyer, I'd really be looking through to where is the market at, and was there a depth of interest around the property that you bought? And if there is 3 or 4 other buyers that are all willing to pay the same, then that's where the market's at. And you should be willing to pay that if you are looking at the right property and it fully stacks up. Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
The pace of change is accelerating. I think without exception, every person, every leader we speak to feels that way. So yeah, I think if listeners are feeling a bit overwhelmed by all the change, I know it's a bit cold comfort, but everyone else is feeling the same way. So we're all in the same boat. Yeah, it definitely is. And it's just an accelerated pace of change, and technology plays a part in that. I think our, population, like the world's population, by historic standards, it's increasing. It's an exponential kind of curve. So there's more people, there's more ideas, there's more things happening, and it's just, we all feel that. So yeah, I saw a sign in a secondhand bookshop the other day, and it said the post-apocalyptical section has now been moved to the current affairs section. Basically all those things that used to be like end of the world kind of stuff, it's now like, oh, that's just what you see on the news every night. So, and that was a bit of a gag that they put up, but I thought, oh, yeah, that feels true in lots of ways. So yeah, so I think one of the pieces of research that we put out, McCrindle puts out every year, is our trends of the year. So listeners can access that. We've got like the infographic summary version that's free online, and then people can access the report or the webinar if they're interested, just Googling trends of 2025 McCrindle. But so I thought there's a couple of things that we're tracking for 2025 that I think would be really of interest to your listeners, and even a couple of things that we highlighted in 2024, which are still very much kind of emerging relevant trends. Sometimes we'll highlight a trend and it kind of starts to get traction, but sometimes it's only a couple of years later that it really is in full swing. We think about population and housing. Economics, I did some economics units at uni, right? You can really boil it down to demand and supply. So let's consider the demand side of the equation first in terms of population and housing. So our population growth has been at record highs, and this is true nationally across Australia. But actually Perth and WA have really been leading the way since COVID, along with Queensland, which pretty much since about 2020, it's been WA, Queensland right at the top of the charts for population growth rate as a percentage. Now, the thing about Australia's population growth is it's largely driven by overseas migration. And really, historically, over the last, say, 20 to 30 years, it's about 60% of our population growth comes from migration, and about the remaining 40% is from natural increase, so births minus deaths. So it's historically been about 60-40 in terms of the split. But just to give you an idea of the scale of actually just the overseas migration we've been having since the borders reopened post-COVID, we're actually getting double the annual migration. Say in the last year, we had over 500,000 people migrate to Australia, whereas in 2019 it was just under 250,000. So basically, it's we're about 2 years on from the kind of international borders reopening, and while that has trended down slightly, it's still double what we were getting pre-COVID. So that's really been a key driver for the population growth, is that overseas migration. And as I said, WA is leading the way in population growth. And a lot of that is through overseas migration, as well as interstate migration. So people from the east moving across to the promised land in WA. When we've kind of run national surveys and we've asked Australians, what words do you associate with a city? Because the other thing I should say beforehand is that the vast majority of our population growth and of our migration in Australia and in WA, it's to the capital cities. So in WA, that's obviously Perth. To the extent that Perth, you think about how big WA is, but actually the proportion of Western Australians who live in Perth, I don't have the number off the top of my head, but it's like 85% plus. So we've got such a huge landmass, but we're all concentrated in Perth. And that's true for Australia. I mean, 2 out of 5 people who live in Australia live in Sydney or Melbourne. So we've got this massive country, but we're all concentrated in the city. So we're very city-driven culture. Now, when we've asked Australians what words they associate with cities, they say the top words they associate with cities are expensive, congested, noisy, overpopulated. And there is one positive one in the mix. It was diverse. So that's there's a positive word. But I think that gives us some clues why people are flocking to WA and Queensland. Because if people are saying, oh, when I think of cities, I think expensive, congested, noisy, overpopulated. Sure, if listeners are from like a regional town and have come to Perth, they might feel that way about Perth. But actually by national standards and definitely by global standards, we've got amazing livability. We're still, even though we've had crazy house price growth in the last few years, we're still relatively affordable if you look at, say, by a national perspective or, that larger perspective. Yeah, we've got traffic congestion, but again, compared to Melbourne and Sydney, where people think that looks pretty favorable. And in terms of noise and overpopulation, like we've got lots of green space, lots of beautiful clean air. So I think we probably get some hints there. It is interesting that the two fastest growing states are really the two biggest lifestyle states, WA and Queensland. So I think that would be some big hints there about why people move to WA. We've started to see kind of bubbling away the last couple of years is we hear a lot in the media when they talk about the cost of living and housing affordability. We hear the saying, the bank of mum and dad, and referring to, of course, people relying on parents or a parent providing financial support, either as they, for their education or for their, their first home and just getting that leg up. But what's interesting is actually we've been seeing more and more grandparents actually supporting their grandchildren financially. So in a way, it's evolved from not just the bank of mum and dad, but the bank of nan and pop now, it seems. And why is that happening? Well, I think there's a few reasons. One is actually that generation, the baby boomers. If you look at the metrics, they've largely, as a generation, have accumulated. Really, they've been blessed with wealth that's been tied up largely in their appreciating home value of their own home. And they've done well out of that. So actually, so much of Australia's wealth is concentrated in kind of that older demographic. And a lot of them, naturally, if they've got family, children, grandchildren, they naturally want to help out. So it does seem to be an emerging trend that the bank of nan and pop are stepping in to help with a financial leg up. And to put a stat on that, when we've surveyed nationally, just people to ask about their financial situation and some of the things around that, we found that when it comes to Gen Z, 60% of Gen Z say they've received some form of financial support from their grandparents, 60%. So that could be a one-off gift, a fairly modest one, or it could be larger. So that's covering all forms. But even if we take that, 60% saying they've received some form of support from their grandparents upon reaching adulthood. So could have been towards a new car or just living with them rent-free or providing, a bit towards a deposit for a house. We can compare the 60% of Gen Z who say they've received support upon, from their grandparents compared to the baby boomers who only 6% said, actually, my grandparents gave me financial support. So actually, Gen Z are 10 times more likely on that metric than the baby boomers to have had a leg up from their own grandparents as they kind of enter those adult years.
So let's take a look back, shall we? In April of 2013, we actually hit our peak market for the the tightest number of properties for sale. We had 7,885. And how does that compare with now? Now we've got 4,986, so about 5,000 compared with 8,000 back then. So we're in a much tighter market than even our 2013 tightest market. And they had about 1,000 properties selling per week. We've got about 950 to 1,000 selling at the moment, so quite comparable in the number being sold per week, but our market's a lot tighter in the overall stock. Inventory, as a result, 1.86 months worth versus 1.32. And median house price back then was 505,000 versus our 775 now. So we've pretty much increased on the median by about 50% across the board since that tightest point in the market. Now, as I mentioned to you, our median kept increasing for the next 3 years after that. We hit 529,000. So we went up about 8 or 9% across those next 3 years. And at that point, our number for sale was 15,178. So it had almost doubled over that next 3 years from 2013 to 2016. And that saw the median house price start swinging back the other way. So the leading indicators of number on the market, number getting sold, were all decreasing across that 3 years. So the writing was definitely appearing on the wall for those of us that were looking at it. And if you were tuning into my market updates back then, you would have heard me telling you. So what was also happening in the rental market over that time is in 2013, we hit a low of 3,800 properties for rent. We went up to 9,875, so basically 9,900 properties for rent in 2016. And that was the peak of the rental supply. The rental supply started trending back and tightening from 2016 to 2019, and that led the sale market then tightening from April 2019 onwards. So interesting that the rental market preceded that. It tightened up, it improved rental yields to that point, and then the sale market followed. So when we compare back over this time, our current number of properties for rent is 2,263. So nearly half of what was for rent at that peak tightness of 2013. We had nearly 5 times the number for rent when we hit our worst in 2016. And when we compare actual yields across that time, we've got a 4.5% yield on the median house price at the moment. At our tightest, we had a 4.8% rental yield in 2013. So fairly comparable to that. When house prices and rental prices dropped, our worst sort of yield that we got down to was 3.8% in 2019. So the yield wasn't terribly flash when we hit the turning point. It was only later, after the stats tightened up on the number for rent, that the rental price started then increasing, improving the yield, and it started to flow onwards in 2020, 2021. So the yields took a massive jump up very quickly and have continued to increase to our 680 per week now. Now let's dig a little deeper into some of that's sort of the trend in properties for sale, properties getting sold per week, and the rental market, and what sort of happened to median house prices over that time. What I want to do now is look under the hood at the fundamentals of our economy and some of those past warning signs that we can then be aware of when we come to you each quarter, and we can start to see the turning points as to, when we might be heading back the other way and when we might not be, continuing to get growth. So let's go back to 2013. The overseas migration in that peak year of tightness in all of the trending stats, we had 46,000 people come to the state in net migration to WA. Pretty good. When we were at our worst of the stats, we had just 12,483 in 2016. And then in April 2019, when things were at their absolute worst, the population increase had actually started to come back up and was starting to improve before it started to show up in the sale market again. So that was a leading indicator. So we had 16,000 migration at that point in 2019. We're now at 50,760 people coming to the state from overseas over the last year. So that's in excess of what we were seeing in 2013. And it's a long way to fall back to get to the 12,000 that was signaled the change in the market and the starting to decrease the median house price in 2016 when we had just 12,000. So a long way to go between 50 and 12. But that's going to be one of the key drivers, population growth and migration in particular, that's going to affect our rental market firstly. So people, when they come here, start out by renting. They then flow through to the house market. Everyone needs a place to live. That's put a lot of pressure on our rental prices increasing and house prices increasing over the last 2 to 3 years. So let's keep an eye on that population growth stat. And they were most current to September last year. So it'll be interesting to see when the next stats come out this year, and the population stats lagging in the time that they're reported, but they're a leading indicator still in terms of what's going to happen to the median house price in Perth. And what we need to look for in this is the danger on the horizon, as we know, and you've heard me speak about in recent episodes, is the slowdown to the world economy caused by Trump's tariffs. So what that's going to potentially do is China's going to likely be most affected by these tariffs. They're getting the highest tariffs imposed on them. It'll be interesting to see how they change around their trade and to what extent that may slow their economy and all of the Southeast Asian economies that are our main trading partners other than the US. So with our iron ore being one of the largest exports, well, the largest export for WA, keeping an eye on that price as well. We were at 36 US dollars a ton in 2016, and it did continue to increase back from there to 2019. We're at $74 a ton. We're currently at $99 a ton. You'd think that the iron ore price, again, is reflective of supply and demand. So if the demand starts to decrease significantly from China, we may see that price decrease and also the volumes decrease that are being exported. So we'll definitely be keeping an eye on that iron ore price and hoping that some of these trade wars go in our favour. I know for Australian beef, China's now suddenly become one of our top importers. We're exporting some of the most to them because they used to get their beef from the US, and now with the huge tariffs placed on it, it's cheaper for them to buy from Australia. And all of a sudden, that whole industry has had a big boom, and China's gone from way down the list to second in terms of where we're exporting beef to. So hopefully we get some wins like that, where what China was buying from the US, they might start buying from Australia. Hopefully the wine industry, our agricultural industries, these types of things, we'll still see that. And hopefully China can still maintain their level of expansion and building and prosperity to a reasonable extent so that the need for our minerals and resources are there. I think the other factor that's worth mentioning at a global level is, as in terms of need for resources, there's a big trend going on to improve and reduce emissions. So that's causing massive infrastructure spends to change over to renewables, which WA and Australia as a whole are very well positioned with our resources to provide for that. And the other trend that is going on still with the war in the Ukraine and conflicts over in Gaza is that a lot of the nations of the world are increasing their military spend as a percent of overall GDP. And what's needed for military spend is a lot of our resources too. So those trends are definitely going against the Trump isolationist slowdown trend, if we call it. And look, who knows how long Trump and his trade wars might last. This could be old news in a month or two, could be completely blown out of proportion, and we may just be looking at that in the rear mirror soon. But as I've said in last episodes, don't worry about what the media and other things are saying. Cut through the BS, invest for the long term, and don't be making short-term decisions based on the news headlines. So hopefully that's been informative. It's certainly given me some perspective as to just how strong our economy and property market is still. And we've potentially got another 3 years of median house price increases is just high level. Obviously, it depends on the rate at which these things change, which I can certainly be filling you in on each quarter when I come to you. And keep in mind, this is just me talking about our overall economy, our overall median house price. At any one time, each suburb in Perth is going through its own cycle, and different suburbs represent better value for buying. And when we have our data-driven approach, we can select the suburbs that are most likely to outperform in the short and medium term, as well as the long term. And that's why I think our buyer's agency has become so popular, in that in previous markets, you could throw darts at a board, select any property, and you would have seen a 50 to 70% increase. Now we need to be a lot more selective. You need to really know what you're doing with your research to select properties, and we can really pay for ourselves even more so than usual because we can make the difference in the extra gains that you can potentially make. Hope this has been a good one. Hopefully you've learned a few things. If you have, share it with family and friends. Like us, do post a review if you haven't done so already. I really appreciate that. It gets the show out to more people. And I'm looking forward to catching you on the next one. Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.